Welcome back. If you're just joining us, we are looking at the outlook for 2020 at a macroeconomic segment. But the question we're all trying to answer today is, okay, so what? You run a business, you want to make investments in this year. What should your key considerations be? Where are you going to get your cash from? Where are you going to get your markets from? Can people be able to consume? We've taken a look at a couple of other elements earlier on in the show, and we are in studio with Jibran, Qureishi, trying to understand, is there going to be cash in the economy? One of the key things that happened last year was a demonetization by the Central Bank of Kenya. What does that mean? Do we expect money supply to increase or not?
Well, I think demonetization is maybe, in my view, not the right word. Because I think what India did was demonetization, where you get the money into the system and you don't get anything back.
Yes.
But ours was a replacement. I don't know what word to use for it. Of course, the central bank told us it's about 8 billion shillings that was not brought back in. Presumably because they couldn't provide source of funds. But I think when we look at demonetization, inherently, when the money is coming back, it should be disinflationary, and you should see an impact on broad money supply, which I think we saw. Of course, a lot of people want to attribute the slowdown in the third quarter on that. But,
yes.
I would actually give credit where it's due. I think the Central Bank of Kenya did a good job in sensitizing the common man about what it means. As to the best of their ability. In terms of information, they went all across the country on radios, television stations, and I think that was very important, because the biggest problem with demonetization is that, or rather, the replacement of those notes is that, people may not know what happens, and they could be sitting heavy cash, and that would impact their ability to trade in the markets, commerce-wise.
Okay.
So I think. It was probably misunderstood in the early days. Maybe a lot of the concerns were overblown as well.
Okay,
I don't know if you remember in the very preliminary days of the announcement, there was a concern that the shilling would weaken because there would be a conversion from shilling assets into hard currency assets. And it was very sentiment driven. So I sit on a trading floor, and we didn't see that.
You didn't see any of that. But the interesting that I had at least last week from a friend of a friend of a friend was they're saying, oh, anybody who has money, just bring it. We'll just 50% discount. Give me 1,000, I'll give you 500. It's like, so what happens if I give you 20,000? I'll just give you back 10,000. Like, what are you doing? Well, I know a guy, at Central Bank. Maybe that's a conversation we need to ask Central Bank to actually validate whether they're still accepting currency that's out there.
Wow, okay.
When you're looking at the MPC, you expect a 50 to 100 basis point cut on the central bank benchmark rate. And when do you expect this to happen? What does it mean for me and my cost of credit? Sure.
So we believe the central bank will have an accommodative bias. So they will be looking to cut rates and keep them low. 50 basis points, in my view, will be a given, but probably at the most 100 basis points, maybe 50-50 in the first half of this year between Jan and June. We've got an MPC meeting next week on Monday.
On Monday, yes.
My base case right now is that they probably wouldn't do anything on Monday, but maybe once they get some credit growth data to assess how their initial rate cut went through. And once they get the final budget policy statement next month, to be convinced that this is how the government's fiscal consolidation plans will pan out, then I think they should make a decision in March or May based on that. Because the reason I keep on bringing fiscal policy is important for monetary policy here is central bank cannot have an accommodative stance if the fiscal side remains expansionary.
Exactly.
Because let me give you an example which I showed you the other day on the presentation. You got the policy rate going down, as we saw in November, and the market's doing something else on T-bills, and specifically T-bills, because that's what provides the short-term interest rate cost of fund benchmark for commercial banks. Then of course the rate cut becomes a bit blunt in terms of its effectiveness in spurring credit. So yes, while a 50 to 100 basis points cut will probably in the near term reduce the cost of loans for the loans that were contracted in the rate cap period.
So this is the existing loans.
Exactly.
But would it apply to new loans? Because for existing loans, it means that we could see loans even priced at maybe 9 to 10% for existing loans.
It depends from bank to bank. I know it's at Stanbic Bank. They're one of the few banks that have reduced the policy rate for all loans as well.
Okay.
In terms of repricing it. But again, it depends on how banks perceive it. But for new loans, again, it's going to be risk-based pricing.
For new loans, don't expect
No.
this for new loans.
I mean, the central bank would obviously argue that not only should it be risk-based pricing, meaning on your ability to sort of service that loan, but they would also argue that they want to keep an accommodative policy stance to keep new loans at lower prices, at lower rates.
Level.
So, you know, the important thing here is it's not wrong for the Apex Bank to think like that, but the consistency between fiscal and monetary policy has to be aligned for the central bank to be able to achieve that objective, to have their rate cuts spur credit growth.
Okay.
Which is why I'm placing a lot of emphasis on the budget policy statement, because
that's the key economic event that we need to look out for.
Yep.
Let me bring you back to the element of risk-based pricing. What does that mean? Can I, Bithe, who runs a business, can I just walk into a bank and have them give me credit, or how would they profile my risk? What sets of information or what data sets will they be using to make a decision?
I'm probably not the best person to answer that. I mean,
Okay.
I think someone in our credit department is probably better placed to answer that. But, you know, more generally as a macroeconomist, I would think that, you know, data scientists are going to be the new in thing for commercial banks.
Okay.
You know, if you look at the kind of jobs that will or should be advertised in the next 2-3 years, I think commercial banks will be hiring a lot of data scientists to be able to not just form these algorithms, but to do exactly what you're saying. You know, what can I use that I know about you that will convince me and instill that confidence to ensure that you'll be able to, you know, pay me back. So I would think it would be a data-driven approach, and of course, could also be a sector-driven approach. But of course, that doesn't mean that banks should smear one client based on governance issue in another sector, if you know what I mean.
That's true. But you know what it also means? It means that if, for instance, I have a bad debt with Standard Chartered, there's slightly more visibility today. If I walk into Stanbic, it's not the way, you know, like 2, 3, 5, even 10 years ago, I could easily walk into Stanbic and put in my loan application, walk out, go into Standard Chartered, put in my loan application, and it would process the same day. But because of data today, you don't have that. There's CRB that's looking at your credit, giving you a credit score. There are a lot more touch points for data that are out there. So maybe that's something to be cognizant of.
But just to add to that, I think also with respect to the CRB, I think, you know, in the near to medium term, what we want to see that would aid risk-based pricing, perhaps within the wider banking sector, and also supplement, you know, lower rates that we all want to see.
Okay.
I think the CRBs need to provide a lot more information on good borrowers as well. I think we have too much information on bad borrowers.
Bad borrower. There's always bad information about, like, if you came here and you're just looking shabby, I would really, you know, I would tear you apart. Nobody likes to get into good information, but that's a valid point. We're coming to about the end of our show, and we just wanted to get a sense of your general conclusions and recommendations when we're looking out at the year 2020. I think our graphics team will put that out from your report. So generally, what are we looking at? We're looking at the year 2020. What are the key considerations? Whether I'm an investor, whether I'm running a business, really, if I'm a mwananchi in this economy.
So of course, you know, at the outset, we have pointed out that GDP growth will recover to just shy of 6%. But of course, we acknowledge that for this growth to be inclusive and sustainable, private sector reforms have to be intensified. But of course, as I continue to mention, not just for growth, but also for monetary policy, the fiscal position is paramount.
Okay.
When you look at it for growth, if we don't get our fiscal house in order, then we will see unpredictable taxes. We will see arbitrary tax assessments that will, you know, increase the plight of an already suffering private sector.
Exactly.
But of course, on the monetary policy side, if we want to see banks lend more, if we want to see increased cash flow and money circulation, then we need a contractionary fiscal policy to be supplemented with an accommodative monetary policy. And of course, you know, these reforms are important, but apart from that, you know, as you also saw in our presentation, we're expecting the central bank to cut rates. We think inflation is going to remain range bound this year. The rains, from what we see, look good, so the tea sector will do well.
Okay.
And you know, overall, of course, there's always opportunities, but you know, it's always important to be cognizant and you know, think about the risks as well.
All right, fantastic. Actually, that's a good point. What's the key risk that you see to the growth or the outlook of Kenya in this year?
Do you want to take a guess?
Fiscal consolidation, fiscal policy.
Yes.
Really, the government. So what you're saying is they need to spend less.
I mean, obviously that's the one for me, but and not just near term, but medium term, but also the weather and the recent swamp of desert locusts and stuff. If it gets to the food growing areas,
okay,
that could hamper agriculture.
But just a quick point on the locusts. I was reading a report from the World Meteorological Organization, and they said it's temporary. Now, by the time we get to March, it's going to have come to an end because there's a cyclone that's going through,
right.
And they actually think it's going to either affect Iran or Iraq.
Okay.
So that maybe the issue there will be, yes, there could be good tea production, but one of the markets that we export into could actually be affected by the onset of the locusts. But
agreed.
Just something that's out there. Thank you so much, Jibran, for your time. That was Mr. Jibran Qureishi. He is the regional head of the economics desk at Stanbic. So the sole word for you is this: yes, the economy is going to grow, but then there are a couple of opportunities for you to be able to touch into either consumer durable businesses, into the transport businesses, agriculture. There are opportunities there. The key risk factor for you, KRA could come knocking, not only today, not once, not twice, maybe even 3 or 4 times. And there could be an incidence of additional taxes. So for whatever you're pricing, that's a key consideration that you need to take into place. Thank you for joining us this afternoon. We hope to see you once again, same time tomorrow. Good afternoon.